I've been investing in the Roth IRA since I was 18, and if you did too, for growth, and averaged a 10% annual return until 60, that means the account would be at $3.7 million, which would be completely tax-free. And that large of an account could bring in $188,000 of tax-free income at that final year, which if we adjust that for inflation, which averages between 2 to 3%, using 2.5% of inflation, that would be equivalent to $92,000 of tax-free dividend income in today's economy. Of course, many of you are above 18, so that example isn't realistic, but no matter what age you're at, getting started with the Roth IRA and prioritizing this over any other account, in my opinion, could significantly impact your financial future, and I'm gonna go over in this video exactly why and how. Now, if you're one thinking, why do it? You may have 20, 30, 40 years until you're even thinking of retirement. Why start this account? The reason it's so powerful is the combination of two things. The first one is the power of compound interest, which means as you invest your money and it grows, the growth in all your money will continue to make more and more money over time. It has a compounding effect. And when you add this compound effect of growth over time, along with the benefit of a Roth allowing you to avoid taxes at retirement, after all of the growth, you're pretty much just investing and knowing that you're growing to avoid taxes on all the growth. So if you don't know what a Roth IRA is, the Roth originated from US Senator William Roth, where anytime you see an account with the name Roth, like even the Roth 401k, you are pretty much going to be paying taxes upfront on what you contribute into the account, and then you can avoid taxes completely throughout the years of investing. You can swap the investments, you can do it however you want without paying taxes, and then at retirement when you reach the eligible age that is 59 and a half or above, you can take anything out of the account completely tax-free and penalty-free, assuming you meet the 5-year rule, which if you're doing it for this long, that's not an issue. So to get straight to it, here's my exact plan on what I've learned about the Roth IRA and how I'm going to be investing into it going forward for tax-free wealth. The first thing you need to know about the Roth IRA is a common mistake I made before and see many people doing is investing into the wrong investments. For example, if you're investing into real estate trust companies, also known as REITs, or dividend investments looking for the dividend income, or bond funds, or any sort of value investments that are not really going to give you that strong growth. Although these are great ways to diversify a portfolio, reduce that volatility, and have hedge against any sort of risk, if you have 20, 30, 40 years to invest in this account, the idea, at least to me, should only be growth. And the reason for that is growth stocks tend to outperform the market over time because of their future potential. But going for growth over any diversification with safe income investments that aren't necessarily doing much for you, at least to me, I don't see the sense in doing it. That is, unless you plan to take the money out of the account early, which the only amount you can do without paying a fee would be the amount you contribute into the account. But I highly recommend not even thinking of this account like that, but more so like a tree that you plant and you keep watering it, and over time it gets big, and then it's huge, and then by the time that you're at whatever retirement age and you want this income, you just keep taking the apples and eating them every year. And then you'll never have to cut down the tree. Now, like I said, I don't own individual stocks in my Roth IRA. The only thing I have are index funds. If you don't know what index funds are, they're pretty much a way to invest into hundreds to even thousands of companies all in one purchase. With an index fund that tracks the US stock market that I'll cover shortly, something like that can do very well over 30 years, where for individual companies over a 30-year horizon, who knows where the companies will be in the future. Many times they actually rotate, so by getting an index fund, it allows you to mitigate a ton of risk for the long term. The largest position that I own that you've probably heard of is the S&P 500, which is considered the stock market benchmark and consists of 500 of the largest companies trading on US stock exchanges. Now, I have my Roth IRA through Fidelity, and I actually prefer to use their index mutual funds, specifically their Fidelity 500 index fund with the ticker FXAIX that tracks the S&P 500, where you can see the top companies are Apple, Microsoft, and Nvidia, all between 6 to 7%. The companies in the fund are all weighted based off of their market cap, which is the size of the company, which is why Apple is at the top. If you're not on Fidelity, or if you don't like another index mutual fund on, say, Vanguard or Charles Schwab, another alternative that you may be interested in that's the most popular and what I like in my taxable account is the Vanguard ticker VOO. We're just looking at the data for this fund. It has averaged a 13.33% annual return over the past 10 years. Then just to see more historical data, the S&P 500 fund through Fidelity FXAIX, since 1988, the fund has averaged an 11.04% annual return, which the numbers I used at the very beginning and for the thumbnail of this video portfolio were at 10% of an average return, which I believe with strong funds you can achieve that over time. But just to emphasize the power of compound interest and exaggerate the benefits of seeing that growth, if it were 1% higher to an average 11% return, the end portfolio would jump from $3.7 up to $4.9 million, which is a $1.2 million increase of only a 1% difference, which I know is exaggerating things, but just understand the incremental difference and importance of growth. But unless you're Warren Buffett, the real way that we need to look at this is not what additional growth investments can we get to go out and beat the market, but more so what investments are we using that are preventing the opportunity for strong returns over time safely. So because of how much time I have until I touch this account, by getting into dividend income investments or bond funds or any sort of diversification, but reduces the strong growth over time. For example, even one of the strongest dividend funds that I use in taxable accounts and is my favorite is SCHD, that has achieved an 11.59% annual return over the past 10 years, which is great, but that's close to 2% lower than the S&P 500 VOO that I just showed you. Now don't get me wrong, SCHD is a great investment and a great way to diversify a portfolio. I love it because it only has 8% of an overlap with the S&P 500. You can earn qualified dividends taxed as long-term capital gains, and it has reduced downside in a poor economy where over the past 10 years, SCHD's worst year was negative 5.5%, where the S&P 500 was negative 18%. Those reasons are exactly why I own it in a taxable account, but not in the Roth IRA, where this is an account I'm not going to be touching any of the money for at least 30 years. But if a simple total US stock market index fund that still has strong dividend companies inside of that fund, but if it can get just 1% higher than a fund like SCHD, I don't see the reason to go out and own it. In fact, it's proven that if you have time to invest in the markets, it's better to invest in growth stocks over dividend stocks, because with growth stocks, you increase your chances of accumulating capital quickly. You see, the difference is that growth stocks typically don't pay dividends, and if they do, it's an extremely small amount because they would rather use their funds to reinvest back into the company for future growth. And if you're thinking, what if a recession comes and the portfolio declines, the plan should be to not touch the money. You shouldn't change anything besides adding more investments and continuing to invest in this account. I literally made this mistake of my own as well because I had a small amount of a bond fund in my account, and it really annoyed me because after about 2 years, I noticed that my growth fund went up like 50%, but my bond fund went up 3%. And I wasn't planning to touch the funds anyways. It literally had no purpose besides less growth and just annoying me that I could have done way better. Please understand, I'm not a financial advisor. You have to invest however you want, but just understand that by adjusting from investments like bonds, if you have 40 years to invest, a bond fund like Vanguard's BND since 2007 achieved a 3.13% annual return. So the impact of having poor investments over a long period of time reduces the opportunity for you to see that compounding effect of growth, which could literally cost you hundreds of thousands of dollars. For example, if you average the stock market benchmark, let's just say is 10%, if you invest $7,000 per year, which is $583 per month, assuming you're at the age of 30, just getting started, brand new to the Roth IRA, you could end at $1.1 million. But if you diversified a portfolio for more income rather than growth, or you got more stable investments to diversify the portfolio, you may average 2% less, which would be an 8% annual return and would make your end portfolio $792,000, which is still a ton of money, but that's almost $400,000 less than if you simply purchased a total stock market fund like VTI on a recurring basis and then just went on to live your life. Please understand this is just information and you have to make your own financial decisions, but this is exactly how I plan to invest in my Roth IRA going forward. Which I will say before moving on, if you are finding value in this content, I would really appreciate it if you considered subscribing to the channel with notifications on for future content like this. To be clear, I only recommend index funds. I don't buy individual stocks over a 30-year horizon. I have no idea what's going to happen, and I don't want to play around with stocks in a Roth IRA. So truthfully, to make this as simple as possible, you could gain enough exposure for all this in just 3 index funds. The first one would be a total stock market index fund like Vanguard's ticker VTI. This is an ETF, so you can purchase it on any platform. It gives you exposure to thousands of companies in the US of different sizes, which would truly give you exposure to extremely small companies all the way up to large ones and see the development of these companies, so as they grow over time, so will your investments. The total stock market version through Fidelity is FSCAX, or what I actually like to do is individually buy the S&P 500 FXAIX, then a mid-cap FSMDX, and a small-cap FSSNX separately three that make up close to one total US stock market fund. So if you like that approach, you would want to do one or the either, but this is a personal decision because I like to see each one separately, how they're performing, and I like to control how much I allocate toward each area. If you're curious on ETFs, the alternatives through Vanguard would be the ticker VOO, that's the S&P 500, the mid-cap ticker would be VO, and a small-cap ticker would be VB. Also understand that the S&P 500 index fund has an 87% overlap with the total stock market index fund, so if you have both, they pretty much just overlap each other. The next index fund I recommend is a large cap growth index fund. That would be like Fidelity's FSPGX, or an ETF alternative could be VUG, or QQQM, or SCHG. I made an entire video on these ETFs if you want to look at that after this video, but these are all growth index funds that are exposed to multiple markets, with the top ones being infotech, where SCHG, for example, has averaged a 16% annual return over the past 10 years. The last investment I own a very small portion of, just for additional exposure, in the case it were to outperform US stocks over time, and that would be through a total international fund like Fidelity's FTIHX. By doing a small amount in this, it allows the portfolio to gain full exposure to the entire world, and yet alone there have been historical periods where international stocks have outperformed domestic. It's completely a personal decision, but the last addition to the portfolio, if you're one looking for even more growth, would be to consider sector ETFs. This would be through index funds, but now they are targeted towards specific sectors, where two of the hottest ones recently have been information technology and semiconductors. Who knows what the future holds, but by viewing the Roth IRA for safe but strong growth over time, I believe is the best approach, and that is until you're at the age of retirement. This is where it gets interesting because you put all this time, money, and energy into building up this account, where once you can actually use it, instead of just taking all the money out, what you could actually do is swap the investments. It's completely tax-free in this account. It doesn't matter. So if you have all these capital gains, if you swap it, you sell the investment, and then you go buy dividend earning funds, this will allow you to earn a dividend income where you can then withdraw the dividend income without having to take money out of the actual investments, because the income could provide everything you need to live off of, and if you build it up large enough, it could be for the rest of your life. Also, just understand that when I say swap to dividend investments, I don't mean to just do this over one night, but more so to slowly transition into a portfolio that can then be more stable. There's many different approaches you could take with handling this money, but I personally see this as the most optimal way because everything in it is tax-free. For example, the S&P 500 pays a 1.23% dividend yield. Besides this fund, I could allocate to SCHD that has a 3.34% average dividend yield over the past 12 months. And then to really step it up a notch, which who knows what'll be the best options in over 30 years, but that would be to get income earning ETFs like JPI and JPQ. These two combined currently have an average 8.4% dividend yield over the past 12 months, but they do have slight differences because they're created to generate consistent monthly income through dividends, more so option strategies. The reason I find these two investments and strong dividend income ones similar would be they can allocate along with the S&P 500 and SCHD to still allow your portfolio to have growth that outpaces inflation while still achieving dividend income, where if you allocate them all properly how you want, you could potentially get a 5% dividend yield. You could go for more dividends or you could go for more growth depending on what you personally want. But if you didn't know, JPI and JPQ, many of these dividend income earning ones that use hedging strategies with options, they're taxed as ordinary income in the range of 10 to 37%, which is why I don't use these investments in taxable accounts, but I see a great benefit from having them in an account like the Roth IRA where it's completely tax-free. All in all, there are so many variables. I didn't want to get into too many specifics, but just understand the concepts of growth now if you have a long time, and then slowly transition towards more dividend, stable investments. I will say, if you are interested to see how I allocate each of my investments and other exclusive content, to consider joining the Patreon I have linked in the description below. And if you're interested in more content similar to this, I'll leave relevant videos I created similar to this in the description of this video. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.